me on to their item?
Yep, just let them know and bring Empower into the lobby now.
Hi, Gabe. Hi, Chip.
Hi there.
Sorry for the delay. We had some topics we needed to discuss in executive session. Sorry to leave you hanging in the lobby. I hope you were comfortable in your lobby.
It's actually very comfortable having a cup of coffee and trying to take in the silence and catch up on some stuff. So good morning, everyone. Thank you, John. That was wonderful.
So second quarter, 403B, you're on.
Fantastic. Well, good morning, everyone. Gabe Dulise, along with Melissa Chumante and Chip Sandville here from Empower. We hope you're having a wonderful summer. What's left of it anyway for the last couple of weeks. What I was going to do is just provide some generic metrics with respect to your two 403B plans, the non-exclusive and exclusive. And then I was going to ask Chip to spend a moment in terms of a field report, what he's seeing, some of the activities, and try to get everything back on track as quickly as possible so you can get on with the investment review with RVK. Hello, Jonathan. Before I do, any questions from anyone, or we're just going to get right to it?
And Gabe, if I could just interject here.
Of course.
This is a you'll notice that this is a new format that we're moving forward with. I flagged it at the last board meeting that we're going to be having RVK as our investment fiduciary providing that investment review. So we will miss Joe Fine and his reviews, but this is part of a new format we're working with RVK to develop. So with that, Gabe, take it away.
Thank you, Tim. Good morning, Sarah and Jonathan. I see them there. So I'm going to share my presentation. Just give me a shout, folks, when you see what I see here. Are you able to see the state of Vermont 403B system?
Yes.
Very good. Okay. So there's two here. So on a combined basis, I'm just going to share some numbers here because there's going to be two reports in all of this. There's the exclusive, the non-exclusive, and of course, the SDIA piece component. I'm going to speak to the larger plan, which is the exclusive plan, but a lot of the trends and assets and similarities are all the same. So that being said, as of June 30th, on a combined basis for your state teachers, exclusive and non-exclusive, $217.6 million, representing 3,740 accounts. I'll say that again because they're broken down here. 217.6 million, representing 3,740 accounts. When we look at the exclusive plan here, there's a listing of the plans. There are 23 plans that fall under the exclusive, and they're all listed here for you by individual contract number. And so for the exclusive, we're looking at 176.4 million, representing just under 2,900 accounts. We're going to look at how their money's allocated, their investment strategy, and then contributions in and distributions out, and then Chip will speak to any trends there. But as you can see here from an executive summary, again, we have the largest positions of the allocations by fund are about 61% of that is all equity, and we'll get into some of the details there. The investment strategy broken across the board. The majority of individuals are split into two camps. It looks like those that do it themselves, that create their own investment allocation strategy, and the asset allocation model strategy, which many of you are familiar with, is the Goalmaker asset allocation solution. Average account balance of about $61,000. When we look at cash flow, just a quick snapshot here of cash flow. So for the quarter, as you can see here, we had, or I should say year to date, we've had $8.4 million in contributions come into this program, $6 million in distributions, representing a net positive cash flow of $2.4 million. And as you can see here, we're providing the last kind of 4 quarters, if you will, quarter by quarter analysis. But for the fourth quarter, where I want to draw your attention line is that last line that says change in value. The first quarter of 25 was very volatile, that you all remember. So the net change in value was a net negative $1 million in valuation. But looking at the second quarter, a $12 million increase in valuation. That's a $13 million swing just in the fourth quarter alone. So you'll see the various components: contributions for the quarter, distributions, fees, loans, etc., payments, and then valuation. When we look at the individual contributions themselves, money coming into the plan, well, I guess we're going to go into investment strategy first. Did I miss contributions? I apologize. Contribution rate, low. Okay, we'll get to that in a second. So when we look at the investment strategy utilization with the corresponding numbers, over on the left, it's a percentage of the participants and the number of participants that are utilizing the various investment strategies, along with corresponding assets. So for example, my total retirement, which is a fee for service paid professionally managed account, there are about 119 individuals utilizing that, representing just under $5 million. There's free online advice for individuals. It's a static program that gives you online advice, free advice, suggested strategies. So 4 people representing 768. But the big ones there, and some are using the target date strategies. You all have target date solutions. As you can see, 400 of those representing about 25 million. But the 2 largest components are the asset allocation model. So you have just about 1,133 participants representing $40 million utilizing GoalMaker. And then the remaining 1,200 participants approximately representing just about $104 million do their own investment asset allocation strategies. We break that down by active participants and terminated participants or individuals that have separated from service. The thing here is that, and what we see not just in your plans, but with other plans, is that many individuals, when they do retire, they leave their money in the plans. There's benefits to leaving money in the plan, as you can see. So individuals that are separated, not only do they leave money in the plan, but they stay invested based on their allocations. And you can see the number of participants and the corresponding assets that still remain in the plan, investing to and through retirement. One of the interesting pieces of feedback we've got from many of our clients, especially those that are separated and retired, is that one, they lean towards more of a legacy plan structure as opposed to an incomes needs structure, which is very interesting, primarily with older individuals, that retire after, say, the age of 60. A lot of them are starting to utilize their retirement assets as, look, we have enough assets, we've done well, we have other assets combined. Now we're starting to think about legacy planning, and a lot of them are now, are very comfortable and have become much more financially literate, and are continuing to stay the course. Years ago, when people retired, they just took their money and they put it in a safe account and kind of lived off that. But participants are staying invested, they're staying the course amidst all the volatility that we've experienced. So it's really good to see. Some contributions activity. So money that came in the door. As I said, 8.45 million came in the door, and that was broken down as follows. There was deferrals, regular participant before tax deferrals that represented 6 million, just under. Roth, another 600 million, employer contributions where there are those, and rollovers. The other category is rollovers. So you can see the monthly run rate there, followed by the rolling 12 months. That looks like contributions are in the $1 million range across the board. And then the individual activities. So money coming in, about $8 million. Now let's look at all the money going out. And what we saw was $6 million going out. That is broken down as follows. Separation from service so there were 223 transactions representing just under 5 million. Now, separation from service also includes individuals that are receiving installment payments, not just I'm leaving, I'm taking my money and I'm going to roll it out to another financial institution, et cetera, so forth. So that's all combined. Required minimum distributions, in-service hardships, credits, quadros, and I don't know why there's $1 there for a death distribution. That was probably just a cleanup of an account. So it was good that there were no death claims for this quarter. So of the 6 million, and you could see in terms of the distributions, they vary across month over month. I'm looking at a run rate of probably just about $1 million, $1.5 million. And then with certain months, it's even less than that. But again, the non-exclusive 403B plan was in a cash positive position for the quarter, which is very good. And it's going to start picking up now as school starts, as we all know. So distribution loans, again, not a major factor at all here. There's only, 42 outstanding loans for individuals that have it, that if they do need it, it's there. And I believe for the month, we only had 1 in June. As you can see, looking months back, we only get 1 or 2 loans a month. This is unheard of in the industry, just so you know. This is fantastic that participants have it, but they don't use it, et cetera, so forth. But it's there if they do need it. Net transfer GoalMaker. GoalMaker looks like it's leveled out around 1,100, 1,120 participants. This is the asset allocation tool based on their risk tolerance and time horizon. So again, there, of the $40 million, there's a breakdown. And we then further break down in terms of insights by demographics and investment strategy. So you could see active participants here, those that are suspended by age and kind of the corresponding assets that are associated with that. So of the $40 million, you could see that the majority of those are individuals in the moderate space, it looks like 19 million. And then by age group, you have the 50s at 11, 12. So from 45 to looks like, again, what we call a mature plan, between 45 and 65 is the bulk of those assets there representing the asset allocation with younger individuals, not too far behind starting their careers. And then we provide assets by the investment funds themselves, those that are Goalmaker assets and that comprise of the Goalmaker asset allocation program, those specific funds versus the non-Goalmaker funds that participants utilize on their own. And as you could see, the breakdown there. Further yes, sir.
What's the fee, current fee for participating in Goalmaker in terms of the fee for assets?
There is no fee for Goalmaker. Goalmaker is a
there is
free
not.
asset allocation solution. The only fee in the plan is for utilizing managed accounts or professionally managed financial advice.
Okay.
And I believe, Chip, what's that fee? Is it grandfathered?
For Goalmaker, there's zero. Yep. And
Correct.
for my total retirement or Goalmaker or managed accounts is 0.35% across the board.
Regardless of assets.
Great.
So 35 basis points.
Thank you.
My pleasure, John. Thank you for the question. So again, we broke down those 23 plans here, as you can see, in terms of each individual. I'm sorry, I don't have the name here. I'm unable to get that in here but from the front, if you call, for instance, a certain contract, you'll see the participant assets, their average balance, the number of participation, just a lot of demographic statistics for you to see by plan representing those plans, as well as, average contributions, loan balances, et cetera, so forth. Net. So, things will continue. Net positive cash flow is always good. And that's the exclusive plan. The non-exclusive plan behind here represents these 30 plans. And I'm not going to go into these 30 plans, but the demographics are very, very similar. And that represents the non-exclusive of the $41 million and 851 participants. And again, the same concept and strategy. So on a combined basis, as I said, 217.6 million for all of the teacher plans, representing 3,740 participants. And again, the same, their cash flow, as you can see, they had contributions in of 1.7, 1.1 out. They had almost a $600,000 positive cash flow for these plans as well. And again, you could see the difference in market valuation, et cetera. And again, it's very, very similar demographics, just along the lines there, active contributing versus non-contributing, distributions. I'm not going to bore you with that, but and again, loans, no loans, 8 loans, the 1 loan there. So those are the plans on a combined basis. And again, Goalmaker here is flattened out at around 300 participants. And again, the same statistics pretty much mirror, if you will, the other plans and the same demographics for each of those schools there for you, referenced by name. So the final thing and then I'll take any questions because I did go through this quickly because I want to give Chip a few minutes here. In terms of the SDIA account, again, now that's down to $21 million, representing 690 participants. And as we know, this is a wasting trust for those individuals. And again, no money in, but disbursements were year to date are about $1 million, as you can see here. So it's just disbursements on the way out. Okay. And earnings, because it's all invested in the stable value fund. So, and again, distribution activity, $1 million. A lot of that was RMD, as you can see, 44,000 separation. There were some death distributions there, as you can see, 57 accounts representing 438,000. But a lot of the activities, there's a lot of similarities there, just on a lower scale in terms of the assets and the participant holdings. So that's what I had on the SDIA. I'm happy to answer any questions with respect to the report. I think the report is pretty much, I give it a B+, A-. It's just continuing to follow the normal trends. So if there's no questions on this report, I'd like to ask Chip to provide an update on what's happening in the school districts, as well as a personnel update that you may not be aware of. So before I go to Chip, Mr. Chairman or any members of the board, can I answer any questions for you? Okay. I thank you for your time and attention. I apologize to be running through this as quickly as I did, but I would be sure to point out anything that's of concern. So Chip, I'll send it to you, please.
Great, thank you very much. Would you mind, Gabe, running to page 15 of the first report, please?
Of course.
Just something there I thought might be interesting on contributions. I just noticed and wanted to throw out those. In May and June, those contribution numbers are higher. And I just wanted to say the other category there in May, quite often as someone is retiring and moving out, a principal or above, typically there'll be either unused vacation pay or some type of incentive, and a lot of times they'll roll that into here. And I just wanted to say that's why that May number is higher. And the June number, you can see it's mostly just regular contributions that's made that number higher. And that is typically at the end of the school year, a lot of people will take their summer pay all in one chunk and say they're doing 10% of their salary and the deferral into their 403B plan. It'll hit all in June, and then the numbers will be a little bit lower. You can see they're a little bit lower in July and August from last year. Yeah. So just wanted to make that clear as to why there's that variation there. And I keep reaching over here because my bigger screen is where I have my report pulled up. So other than that, I would just quickly want to hit on a few things. Right now, Brian Feisick, who is normally with us for these, is in Franklin Northeast Supervisory Union, had an opportunity to go do a new employee orientation. And that's the season we're in now. We're doing a lot of those, making ourselves available wherever they'll let us in to be there for in-service days as the school year starts. It's a great time of year to be there. Everything's fresh and clean and shiny, and everybody's excited for the new year. That's what Brian's doing today. As of right now, there's a little bit of a summer slowdown leading up to this. Of course, as hard as I try, I find it difficult to get teachers to go back to school in the summer. But as I said, we're gearing back up into the new year. So we're doing that. Statewide webinars starting back up again here soon. Virtual appointments through the summer, again, has just been a godsend for us. That is a great way to get in front of people, especially teachers, through the summer and during the school year, actually. But very heavy presence started for next year in the schools. We're physically going to be just about everywhere again. It's been a slow build up getting back into some of these places, but we're happy to report that pretty much everywhere is open to letting us back in the doors again. And what we're talking to people about when we're there, RRR's retirement readiness reviews. What's your goal? Where are you? What do you need to do to get from here to there? In that process, we're looking at contributions. Is your beneficiary updated? Have you registered your account? Do we have updated contact information? Are you getting your statements? All of the regular things. Enrolling the new teachers. That's what Brian's doing today. And of course, answering any specific questions they have on things. The big thing I wanted to make sure we talked about that Gabe referred to is a lot of you have seen Gillis Owen on our calls here. He was a rep with us. He had a new opportunity. He's moved on to take advantage of that opportunity. So we're in the process of hiring somebody to replace him now. We should see that coming soon. That's I wanted to be quick to get you back on track. Does anybody have any questions about what's happening locally? Great. Back to you then, Gabe.
Question, Chip.
Oh, yes.
Sorry to come in late. Just a question in regards to plan participation for Vermont. Do you have any rough data or just a rough idea of how Vermont, in terms of teachers participating in these programs compared to other states? Are teachers good about enrolling and thinking about the supplemental income from an additional retirement account, or do we lag behind other states as far as participating in these programs?
Gabe, do you have an answer for that?
Yeah. We do have a 403B book that I can compare to. I also am going to ask Jonathan and Sarah to see if they have any insights as well, which will be important.
Yeah.
But I don't have I can get some data, George. Was that you, George? Shock. Hi,
Yeah,
George.
it's me.
Yes, hi, and thank you for the question. I will tell you, generally speaking, with 403B plans, the challenge is that there are still a lot of school districts, or I shouldn't say just states, but there's a lot of 403B plans that alter multi-vendor environments.
Yeah.
And a lot of the employers don't have that data. They just let their participants deal with whatever vendor they want to deal with. So sometimes gathering that data is hard, but I'm sure we can get some. If there's some studies out there, I will look into that for our next meeting, the next VSTRS meeting, to see if we have anything that we can make some comparisons. But I don't want to venture to guess to say that the state, Vermont is doing any better or lower. It is a unique field now, believe it or not, because there's so much emphasis on corporate structures and deferred compensation, so to speak. But teachers has always been, I'll call teachers programs, hard to come by. Data's been hard to come by because of the multi-vendor environment.
Yep.
And there's, as you probably well know and have been through, so many states, especially school districts, are consolidating, so to speak. So that adds a layer of complexity to it. But I'll definitely look for something. I don't have anything at my fingertips, and I would ask Jonathan and or Sarah to see if they have anything, because I'm sure they work with 403B programs as well. So
Yeah, it's just a
any thoughts?
curiosity, not a.
No, it's a great
data. I'm just
question.
curious to see
It's
where
a
we
it's a
stand.
great question, Scott.
Yeah, and we do have some peer group data, but I will emphasize, I think, Gabe's point on the plan structure and whether or not they have a multi-vendor structure, whether exclusive versus non-exclusive plans will have different participation rates. So, and I actually, Gabe, correct me if I'm wrong, but this is something I looked at for the plan, and I do know we have participation rate information for the exclusive plan, and it's around, I think, 13% or so. But for the non-exclusive plan, I think because we don't have all the eligible employee information coming to you all from Vermont, you may not even be able to track that. Is that accurate, or correct me
Yes.
where I'm wrong?
No, I agree with that.
Spot on.
Yep.
I
All right,
will
thank
say
you.
this, though.
Oh, go ahead.
I will say this as a final thought. What I have seen, and I'd love to, again, Sarah, your perspective here. Over the years, there has been a shift in the 403B space to consolidate. So we are seeing employers now, states or 403B saying, look, we've got 6 vendors. We have 16 vendors. We have 12 vendors. Let's knock that down to 4 or 5. We have seen that over the years. There's been an active, presence to consolidate because it's too confusing. And then the biggest challenge is what Sarah said. It's the eligibility in the files. We simply don't get data, and employers will just send a check representing 5 people for the school district to the retirement vendor that of their selection. So the data is probably the most critical that we don't get. But there has been an active movement. Would you agree with that, Jonathan, or in terms of a consolidation with multi vendors? Are you seeing that? Have you seen that?
We are. I would say that there are obstacles to that.
Yes.
Both
Yes.
Perceptions of choice, both as well as just plan preferences
Yeah.
and participant population preferences. But it's an important topic, and I think it could be a good research takeaway.
Excellent. Hope that helps,
you.
George. Hope
Thank
that
you.
helps.
Yeah.
But thank you for the question. Thank you for the question.
My world's
Yeah.
more limited to just Vermont, but one thing I notice comparing plans here is that teachers tend to save at a higher rate than what I normally see, which is I'd love to see, that and taking advantage of like the Help Me Do It options, the target date funds and things like that at a pretty high rate. We do see that happening. Kind of attached to your question, but not quite what you're asking. Any other questions?
Now Genevieve has a question. Hi, Genevieve.
So I have a question. So we're at our school, we have multiple vendors. We're very happy that Brian's going to be presenting to us on the 26th to, tell people about the programs and stuff. But one of the things that we have here is the 457. And so just wondering, should that be part of your presentation too? Like how the 457, because I think a lot of our members do that plan instead of the 403B. Is that under Empower as well, or?
I might jump in there. That Empower does manage the 457 plan. The way that works, though, folks, the teachers, municipal workers, and state employees are all eligible for that, but the state board is the fiduciary for that plan. And so from a reporting perspective, we Chip and team, they provide a similar report out to the state board on the 457 plan, because they serve the role that you folks serve for the 403B plan for everybody. Does that make sense?
Okay, yeah, because I've been telling my members that empowers the system that's, watched by VSTRS, but then I guess I can tell them that the 457 is watched by the state board that.
VSTRS, yeah.
And in the past, I've asked participation rate of teachers in the 457, so we could have that breakout. To your point, Genevieve, that we have what 3,000 people that are participating in the 403B. How many are doing exclusive 457? So again, participation rate, the combination of those two, we may have a higher participation rate than we know about just looking at the 403B.
I agree with that.
Yeah, that's a fair statement.
Because I know and also by district plan design, my district is not an exclusive plan design. And one of the things that, my old district anyway, and one of the things, at one point we had 42 vendors. And now because of the IRS change with the plan design, we went down to 6. And right now, all new hires only have the choice of Empower. So through attrition, we eventually will become an exclusive, the Mount Mansfield School District. But I think that's one of those trends. But I would love to see what the participation rate of, if you can extract that number from the 457 plan, that would be wonderful.
Yeah, I would say definitely for the exclusive cohort, participation data is available and can be benchmarked. And the exclusive cohort of plans is really where the majority of assets and participants are. So to the extent we can benchmark that, we will. We'll work with Empower to also get any data they may be able to share with us on relevant peers in that cohort, of similar state 403B plans, and we also may be able to supplement that with data on our end. So we'll all collaborate on that, get back to you some more color.
Thank you. Other questions?
Well, on behalf of Empower, thank you guys. We're here to listen in, and we're excited to hear about to see and hear about your new investment performance review here conducted shortly. So back to you, Mr. Chairman. Thank you.
Great. Thanks very much for the information. Enjoy the rest of your summer.
I sure will. We'll try.
Thank you. Next on our agenda is the RVK 403B plan update.
Great. And I think we'll move in a couple parts here, but I just wanted to lead in quickly that really appreciate RVK's putting together a book of information for presentation today. So only the first part of this will be sort of the accompaniment to the quarterly review. After that, we're going to hit a couple items that we've been talking about for the last few months. And then I just wanted to note in the at the very end of the report, in response to a question from, I think it was at the state board, but someone raised a question a few meetings ago about the differences and sort of the pros and cons of utilizing a stable value fund versus a money market funds, and really appreciate RVK kind of took that question and put a deck together for board education. That's not something we plan to discuss today, but it's at the very end of the deck, and it's a good reference material. So I just wanted to highlight that and say thanks to RVK for putting that together. But for now, I'll turn it over to Sarah and Jonathan to present their review.
All right. Well, thank you all. Jonathan will lead first with the quick capital market update, and I will go through the rest of the agenda items. Jonathan, take it away.
Great, appreciate that, Sarah, and appreciate the board's the opportunity to provide an updated and new format to the board. We know that there's a number of different components here that we could go into extreme depth on, but I'm going to try to keep it brief in the interest of time. And there's a lot of points that we can certainly follow up on. We always start our performance report with a capital markets review, which sets the context for the the quarter that we're reviewing and the market environment that is really drives a lot of the performance of the underlying managers and investment options. So although 45 days about have passed since the 6/30 quarter end, a lot of political and economic matters in play. Certainly looking to give you context here for performance results. There's a good amount of information here textually as well as in indicators on this, but effectively some of the key points that I would highlight going into this, and there's information on this in several additional slides here. But as we noted in the May meeting, Q2 started off with significant volatility associated with political, economic matters, tariffs, but ultimately Q2 saw strong market performance. Global equity markets, as I think we're familiar with based on kind of the overall performance of many of the investment options, rose 11.6% in Q2. That was driven by a few factors: easing U.S. tariff tensions, although that's still a wild card to a degree, a weaker dollar, which impacts global performance denominated in dollars, and continued economic stimulus in several non-U.S. markets. Non-U.S. developed and emerging markets outperformed the U.S. I think that's an important consideration to look at when you're looking at the different options and what participants may be allocating there. Global bonds also posted strong positive returns. The only major market segments that were negative calendar year to date were small cap stocks after a really challenging first quarter, and REITs, which are the publicly traded real estate components. Frankly, I guess just from a forward-looking perspective, all eyes are on tariff announcements, deals that are being struck, as well as the FOMC's or the Fed's next rate decisions next month. Would say that the market's broadly expecting that will now be a first of potentially several reductions in the remainder of 2025 and into 2026, which obviously the timing and the pace of that could change many aspects of market performance. I would just highlight that as of today, after yesterday's strong market performance, I think it's important to note that the S&P 500 and the NASDAQ both actually hit all-time highs in today's trading session so far. So we're actually kind of at all-time highs on those two indices, which I think is a point of consideration when you're looking at this both from an individual as well as setting up an overall investment program. Although would note that calendar year to date, just to bring us up to current, global equities are still outperforming calendar year to date. Just on the next page, what we've provided, we always try to provide continuation discussions where possible and interesting trend discussion points that help contextualize these discussions. This chart is a continuation of the volatility trend theme, and this shows 4 potential forms of quote unquote fear benchmarks that can be considered in line with the volatility measures, and looking at different points that have driven market performance. So we have 5 specific points with shaded periods on the in the chart. The 4 fear benchmarks, there's some technical components here that we can obviously go into increased depth, but I'm just going to highlight the fact that these are specifically VIX, which is a volatility indicator, a measure of the spread, a risk premium for how much banks actually are looking on the second one in the dotted blue line on the bottom, looking at the risk points that the banks actually have relative to lending to each other. We have a line here as well looking at oil prices, which obviously there can be macro trends, as we saw with the escalation of the Israel and Iran cycle, as well as the corporate investment grade spreads, looking at the risk premium that participants in the bond markets require to take on additional credit risk. And the main takeaways from all four of these measures would be that there have definitely been periods of volatility. Obviously, the April period saw the most pronounced spike in VIX, for instance. But as you would expect, perhaps contextualized with overall market performance being strong, key measures of volatility have actually moderated since then and actually have returned to levels that we were seeing at the beginning of the year. Just for DC plans, what I would say relative to this as a continuation message, this really just continues to highlight the importance of offering a wide range of diversified and risk-aware options to participants, emphasizing the importance of using educational and allocation tools, and reminding participants of the long-term nature of the investments that they're making in these supplemental plans. We have, both equity, fixed income, non-US equity, and some alts, metrics included in here just for your later reference and takeaway. But in the interest of time, I'm going to turn it over to Sarah to walk through the performance metrics and kind of the plan review.
All right, thank you, Jonathan. Before I get started on the plan review, which I'll keep it higher level, just want to thank Empower for providing us with all the information we needed to put together a comprehensive report. We really rely on the record keeper for doing our job and getting the information we need. And client onboarding is not an easy task. It requires a lot of back and forth with the record keeper. So we do really appreciate the responsiveness from Gabe, Melissa, and the rest of the team throughout this process. And we really appreciate their help. With that, in the report, we start first with just a high-level snapshot of the single deposit investment account, followed by the teacher's plan. Won't cover anything related to cash flows or participant account activity. I think Gabe really did a very nice job at Chip covering that. But overall, the plan, as you know, is fully invested in the State of Vermont Stable Value Fund. This is a multi-manager strategy managed by Mission Square Investment. It's structured as a commingled product. It's an institutional quality strategy, and we can spend more time on that in later sessions. Overall, as you can see, the most important aspect is that we are comparing it here to a reasonable benchmark, the Morningstar US CIT Stable Value Index, which is a benchmark of similar stable value strategies that are also pooled investment products. As you can see, it has really performed nicely relative to peers as well, and the benchmark. So we're looking at the peer group of stable value managers, both commingled funds and separately managed accounts. Compared to peers, it has ranked in the top 25% of its universe across nearly all time periods. We think this performance is impressive, especially against the backdrop of some changes that Mission Square has experienced, and we have discussed that with you in the past. Mission Square Investments parent firm, Mission Square Retirement, experienced outflows. There has been turnover on the manager level as well in its portfolio management team earlier this year. So our research team has flagged this one for us as worth monitoring more closely. Ultimately, however, the team managing the strategy currently is very experienced with long tenure with Mission Square. So we don't have any immediate concern, but just wanted to flag this for you as something that we'll continue to monitor, and we may bring up at later meetings as a potentially a strategy that could be worth further due diligence. Jumping to the teacher's plan, we include some stats here that we think are helpful to monitor and on a high level from the plan. I will not cover those today for the sake of time. We also, on this page, we track how participants are using the investment menu. We break it down slightly differently from Empower in terms of assigning cohorts. We look at folks who are invested in your zero price target date funds as folks that are looking to be making their own investment decisions. And so we bucket them under Do It For Me. Also, anyone who's invested in the My Total Retirement Managed accounts, we include them into the same bucket you'll see that about 15% of all participants, and throughout this report, we are looking at the aggregate assets and participants across both the exclusive and non-exclusive plans. 15% of those participants are invested fully in the target date funds. Another 3.8% are invested in the My Total Retirement Managed Account service. That's the service for fee. And then there's also another cohort, around 38% of participants who are in the core menu but are invested in GoalMaker, which also is an asset allocation tool. So we weren't able, unfortunately, when we put together the report, to separate them out. But in the next report, we are going to be including them under the Do It For Me cohort. If you look at this whole group together, that is about 58% of plan participants who are looking for the plan to basically offer them a managed asset allocation tool that automatically makes update, whether it's the target date funds, managed accounts, or GoalMaker. That 58% is actually very much in line with other DC plans that we work with in terms of the percentage of participants who are invested in target date funds or other tools. There is another 36% of participants who are invested in the core menu, fully invested in the core menu. And then there's a small percentage, 5.5%, who are invested both in the core menu options and the target date funds. And finally, for those who are looking for maximum flexibility to be building their portfolio from scratch, you do offer the Charles Schwab self-directed brokerage window, offering access to tens of thousands of funds and securities. And it currently only holds 0.1% of assets, and it has about 3 participants in total. And that's actually very consistent with what we see in other plans. In terms of the investment menu itself, we like to put together a monitoring dashboard that really is meant to highlight some key metrics from the rest of the report that we really think are very important to be looking at on a quarterly basis. This page will likely evolve over time. No two plans in our DC plan base really have the same exact page. The goal of this page is to highlight important qualitative and quantitative indicators that we think are important to review. So here we're looking at, we will be flagging any organizational changes or changes in strategies that happen during the quarter that we want to bring up or we think are worth monitoring further. We will also be looking at fee ranking relative to peers, as well as a few long-term performance metrics. Now, while we do present shorter-term performance later in the report, we really think it's important for the purpose of this page is to keep this long-term focus. So you'll see that we're flagging excess return of the manager relative to an appropriate benchmark, as well as their ranking relative to the most relevant peer over both a 3-year period and a 5-year period. And then in addition to that, we look at prior 5-year rolling periods, which are color-coded on the very far right. For active managers, we really think it's important to exceed the benchmark and outperform your peers as well. And a green box means that the manager is exceeding the benchmark and peers. Yellow means that an active manager is either underperforming the benchmark or peers. And then finally, red means it's actually underperforming both its benchmark and the median peer in that relevant peer group. For passive funds, however, peer group comparisons are not as relevant. The most important metric is how well you are tracking your benchmark. So for passive options, the key metric we are focusing on is whether tracking error or performance deviation from the benchmark is within a reasonable range. So that reasonable range will vary for different asset classes. Some asset classes are easier to track than others. So overall, as you can see here, that in terms of your passively managed options, they are all tracking their respective benchmarks within a reasonable tracking error. So they are generally green. T. Rowe Price target date funds. This is actually one of the top target date funds in the US market today. You offer 6 vintages. For target date funds, peer group comparisons are not as relevant. That being said, they have been doing a good job outperforming peers in many of the time periods and over the long term. And the benchmark performance that we're showing here is their performance relative to a custom zero price target date benchmark. And underperformance simply means that their tactical allocation decisions has not added as much value over those time periods. Over the long term, however, tactical allocation has added more than 10 basis points or more to return over the 10-year period. And this underperformance doesn't really represent general underperformance relative to their goal. We think they have done really well managing to their goal of generating income and maximizing income replacement for participants. For the active funds, they are you offer both a active US and active global equity options. These are both sustainable fund options. You can see that they have actually faced significant headwinds in recent periods that really impacted the long-term results. Our manager research teams has assigned them a research rating at this time because of that, even though both of them actually have been assigned a positive rating in the past, but they are currently undergoing additional due diligence due to those performance challenges. Some of it are manager specific, but a lot of it is driven by energy, for example, outperforming in prior years, which has been a headwind for strategies that under-allocate to energy, as well as in the last 12 months in particular, with the expected change in the administration, and then with the new administration, certain themes like renewable energy or electric vehicles have really faced significant headwinds and have underperformed the rest of the market. So those tend to be represented in those type of strategies. So this has also been a headwind. So more to come on those as well. PIMCO has faced some performance challenges. You offer a PIMCO total return sustainable strategy as well. It has underperformed its non-ESG counterpart, the flagship PIMCO total return strategy, over long term, but it actually has done much better in the most recent rolling time periods and in the last couple of years. So we're seeing an improvement in their performance. These are, I think, the main ones I wanted to flag for you today. And I also talked already about the State of Vermont Stable Value Fund. We are going to be presenting to you today a structure for putting managers on watch potentially and for monitoring managers and potentially thinking about steps to take once a manager is considered maybe one that is worth additional due diligence and performance tracking and monitoring. So this process, I think, will be helpful for us in the future to maybe bring ideas to you in a more methodical way. And we will be following up in the next few meetings with more color on managers that we think are worth additional monitoring, which I flagged them for you today. But as you can see, for the majority of them, these are institutional quality. For all of them are institutional quality managers, and the majority of them are positively rated funds that we also recommend to our clients. But on every menu, there will be issues. That's for sure. Oh, sorry, I interrupted you.
Sure. Can you explain the ranking system?
Sure. So our ranking system, a positively rated manager means that this is a manager that we consider to be a best idea within its own asset class and space. So it's a manager that we would likely bring to our own clients, depending on their mandate. If it's provide a good fit, it's likely a manager that we would include in a search, for example. A neutral manager is a manager that we don't necessarily have any immediate concerns with. So we would not recommend that our clients would terminate those managers if they hold them on the menu by urgency. But we do not consider them best ideas in their specific spaces, which means we don't think they will likely outperform our best ideas over the long term. And then finally, a negatively rated manager would be one that we think action needs to be taken in the in intermediate term, at least depending on manager, client's own policies, to either make a change or at least conduct additional due diligence. If a manager is assigned a research rating, it means that we are currently experiencing some changes with the strategy that may result in a rating change. So, for example, those two sustainable strategies have a research rating because even though we like them, there has been significant challenges that we think may warrant a change in rating, but we haven't made that decision yet. An unrated strategy is one that we have done research on, but we haven't done enough research to provide a comprehensive rating yet. So this really only applies to your State of Vermont Stable Value Fund, which we have met with repeatedly, but we're still doing additional research before we assign a formal rating.
Yeah, I was wondering for the 3 and 5 year, the ranking numbers. Is a low number a good one, right? And the higher the number means it's not so good.
Correct. Yes. Oh, sorry. Yes, exactly.
Yeah.
So low number is better. So if five ranking means you're in the top 5% of your peer group. And then, yeah, so you want it to be as low as possible. And then, yeah.
Thank you.
Of course. You're welcome. All right. So I think unless Tim or anyone else has anything to add or questions, maybe we can switch to our next agenda item, which is.
I think that's right. I think that page 24 chart is one that will be very useful over time. I think, Empower kind of portrayed member for performance in one way. This is a little different, but I think it's going to be very helpful, especially as we look over an investment policy statement, get that in place and a watch list policy. So this kind of took a little bit of back and forth with RBK, but really appreciate the work on it. Thank you.
Thank you, Tamir. We appreciate, I think, all the collaboration on the report as well as other meeting deliverables. All right. So the next item on the agenda is one that Tim has already previewed with you all at the last meeting, which is the fund share class review. You may recall that RVK staff and Empower completed a detailed review of your current mutual fund options across all the supplemental plans, looking at aggregate assets across plan. Few funds were identified where you are currently eligible to lower fee share classes, which are outlined here on this page. You'll see that some of them are also funds within the 403B plan. At least one of them, the Vanguard Institutional Index Fund, is one where having assets aggregated between the 457 and 403B plan is part of the reason why you qualified for lower fee share classes. And this is really one of the benefits of leveraging the state scale to offer a DC retirement plan to state employees, and then leveraging that to also, to the extent possible, offer similar menu options where you can negotiate lower fees for all your participants and ultimately result in cost savings. We discussed with Empower the process for making any changes, and it should be fairly straightforward. It should be typically takes about 90 days for Empower to, after board approval, to reach out to participants, send the necessary communication, which participants are required to receive a 30 to 45-day notice before any fund changes, and then to implement that fund change as well. Tim, anything you want to add here?
Yeah, I think this is just a great move. It's going to, it'll save over $35,000, for our members. Sarah, I wonder if you could just scroll back up to page 5 in your executive summary where you highlight the two, right there. So you'll see the Vanguard fund goes down from 4 bips to 2, and the Lord Abbott goes from 38 to 32. Now there is 10. We wanted to come back and just make sure we understood the revenue share. So there is 10 basis points of revenue coming back to the plan. Our belief is that, you know, if we're eligible for a lower share class for our members, we don't really want to look at that revenue share coming back to the plan. We want to just make the move. It's not substantial, and it's at the end of the day, we want to get the best rate for our members. So what we're recommending at the staff level, I think with RBK support, is that the board move. Justin gave me a motion, so let me just look at it really quick. That the board move to authorize the transition of the mutual fund options articulated on page 5 from the higher share class to the lower share class. Or Justin, if I've gobbled that up, let me know. But we are recommending that the board act on this today.
If someone comfortable making that motion.
So moved, Aaron.
Do we have a second? We have a motion and a second. Further discussion? Hearing none. All those in favor of the motion, please say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? Motion carries.
Great, we'll get to work on those right away. Thank you for doing that. I think the next, and I'm recognizing that we are over time at this point, but I do want to just get on your radar the investment policy statement that RBK has helped us work on. Our plan all along has not been to ask for action on this item. It's been to, you know, this policy statement will inform sort of our theory of how we manage our investments going forward and our selection of funds. So it's something we wanted folks to take some time with and, you know, hear how Sarah and Jonathan present it. And then our hope is to come back next meeting for action on this, both the investment policy statement and the watch list policy. It will be a sort of foundational document. So we thought it made sense to have over 2 meetings, but in the time we have left, if Sarah or Jonathan, if you could just go over in broad strokes the presentation you have on the IPS, that'd be great.
Yeah. Oh, thank you, Tim. We'll keep it very high level. So we understand this is an important milestone. That's why staff and RBK felt it's important to at least take some time at first to discuss why now, what to look for in an investment policy guidelines within a DC context, and share with you staff's very thoughtful proposed timeline for moving this from draft to adoption. So overall, I just want to emphasize that even though this is a really important milestone, a lot of it is us simply turning unwritten rules that you have already been following all along into clear written guidelines. This is very helpful for the purpose of documenting your existing due diligence process and also making sure that going forward there will be consistency in applying those standards to the extent possible. Of course, there will have to be variation depending on circumstances, but more importantly, of course, if there's ever turnover on the board side or within staff, which is bound to happen, your successors then won't have to improvise or sift through meeting minutes. They will have this clear shared playbook that they can look at and rely on, and there will be continuity, which will be important for plan participants that rely on you all to manage their assets. So we highlight here just how this whole process fits within our governance framework. Overall, everything is really all connected, and it's about building habits that are easy to sustain in terms of setting goals through policy structure, and then designing the investment menu in an evidence-based manner, keeping a steady monitoring rhythm that is supported by documentation, and making sure that staff and the board are aware of any important trends or changes through having a regular fiduciary education. That is the general governance framework. Now, when it comes to an IPS itself, it's not just an aspirational document of this is our goals. It has to be something that you think is usable and will provide clear guidance on standards to follow as planned fiduciaries. So as you review those documents, think of them as they're a document that is not meant to be too rigid, because if they are too rigid, too prescriptive, they may impede you all from reacting appropriately to certain situations that may not be foreseen in advance. So the goal is really to balance providing standards with providing you all with some flexibility in how to apply those standards to different circumstances. So what should you look for in an IPS? And what we have included in this document in front of you is some high-level guidance on the purpose and objective of the plan, in clarifying the investment structure of the plan overall, and without being too prescriptive, so general what the range of investment options to be offered to participants and the role those options play for participants on the menu. You have structured the plan menu into tiers, so that is to be described in the policy document. That's how typically we've seen those DC plan documents. Then there's typically a description of key plan fiduciaries, such as the board or staff or the consultant, what the role is, who does what. And then ultimately, a key piece in a policy is to give staff just a principled way of thinking about selecting managers, adding them to the plan, and also how to, on a day-to-day basis, monitor and make changes to plan investment options. In many cases, DC plans would have additional policy documents that will provide criteria for initiating additional manager due diligence in the case of significant manager changes or underperformance, and the specific steps to be taken to remove a manager from that watch list. And that is the approach we have followed here. You will find that in addition to the investment policy guidelines, we included an additional watch list policy that provides some additional context around what the process should look like, again, without surrendering all the flexibility that you may need throughout that process. Overall, those essential components, both in the policy and the watch list accompanying policy document that we shared, you'll find that a lot of those components really mimic the VPEC investment policy statement, which we felt was an appropriate reference and provided a solid structure for the policy document. So you'll find that there are a lot of similarities between those two policies. So what does it all mean in practice? Maybe last point is that as you review the document, you want to think about the end goal of having less ambiguity, more structure to, again, both document your process and make sure there is consistency going forward. Policies work best when they are being followed and refreshed. So it's not a set and forget it type of situation. So you'll find that the proposed IPS provides a number of periodic review cadence items for you all and for us, for staff and the consultant to follow in terms of periodically reviewing investment fees, reviewing the investment policy itself periodically, conducting manager due diligence, doing quarterly performance reviews, and it also includes clear responsibilities for staff and us to be monitoring your managers, monitoring your vendors, and providing you with periodic fiduciary education. And so for you all, it really, you want to think about, do you think, as you review the policy, you want to think about, do you find those processes, do they read well? Are they consistent with your understanding of your role and the items that we would typically be reviewing on a regular basis, do you feel that the level of flexibility being offered in the policy itself is consistent with your needs as a fiduciary? And do you really find that those general principles really align with your understanding of the plan itself? After you do that, I think our goal is for you all to be able to have enough time to share your feedback with staff and with us. And we would then be happy to incorporate any feedback you provide between now and the September meeting into the policy draft. And then we will return to you in September with an updated policy document as needed and an updated watch list policy for your review and potential adoption at that September meeting. Once adopted, the following steps would be for staff and our VK to start then using that framework as our North Star to guide our recommendations to you all. So we may come back to you, as I mentioned earlier, with potential recommendations for adding managers to a new watch list for the plan, or other recommendations as needed. So this is really our general proposed timeline, but I wanna pause to see if, Tim, you have anything you want to add here or to correct me.
No, I think that's spot on. We wanted to kind of give folks time to, as I think about it, you don't want the porch too hot or too cold. We want to make sure that this is just right, and it feels like it both does to some degree constrain our activities within the general governance framework we've been following, but also provide us the right amount of flexibility to react to things that are going to come up inevitably in the course of these plans. So I did want to also just reiterate Sarah's point that we started from the VPIC investment policy statement just as a general approach that our systems have taken to investments, but then of course adopted them to the specific plans at issue here. So I think it was a good process, and very eager to get any feedback or thoughts on them.
Thank you, Tim. Now, in the addendum, we included the draft policy statements for both the 403B plan and the single deposit investment account, as well as the watch list policies for both of them for your review and feedback. Any initial thoughts or feedback from anyone, or just general questions about policy documents for us?
After reading through it, long overdue. I think it's concise. I like the flow. It's easy to understand, as Tim just said. It's general enough to give guidance to us. But if we need to be nimble at something, staff and the board has that opportunity. And the fact that it's a live document, that now having this on the books, we'll, an annual review, having you folks on board, helping us evaluate the current fund status. I think this is a perfect package. I really was very pleased reading through. I think my head got tired nodding as I read through it all. So I really appreciate the way this was laid out, and the fact that it was done in conjunction with VPIC. Because so much of what VPIC did when they were in the treasurer's office, now that they're a separate entity, we're now learning how to be our own entity without having them being a direct player with this program. So I appreciate everything that you've done, and we'll definitely forward any questions that I have.
Thank you so much for this. Yeah, we're happy to, and if there is anything that is worth discussing further at the next meeting, once you've all had a chance to review, we're happy to do so. There are a couple of items we flagged here, but for the interest of time, we can defer them to the next meeting, maybe to touch on as needed. But yeah, as Tim and I said, I think this is your policy document, and we want to make sure that everything reads well and makes sense to you all. And we're happy to take any feedback and make adjustments as needed. But we appreciate everyone's time today and the review.
Can I make a comment as an outsider, just so to speak, as your provider? I've, in my 30-year plus career, I've seen a lot of investment policy statements, but I got to tell you, don't underestimate the importance of this, and just a wonderful job that RVK, whether with the investment review with Jonathan and Sarah, this is outstanding. This is outstanding. You'll be very, very proud of this result. Congratulations to you all for doing this.
You're very kind. Thank you, Gabe.
Thank you. It's impressive.
Other questions, comments? Right. Well, thank you all for the information. Sarah, Jonathan, Gabe, Chet. Great review.
Well,
Thank
you
for
all,
all the
and
hard work.
thanks everyone, and we appreciate you giving us some additional time today.
Oh, yeah, important stuff, to say the least.
Yeah, it sure is. Thank you all for the opportunity to serve all of you and your participants. We greatly appreciate it.
Very good. Thank you. Okay, we are no disability, so we are now, any other items, other business to come before the board?
And nothing from staff. Thank you, and sorry for the extra long meeting, but thanks for bearing with us today.
It's rare that we do it, but when we need to do it, that, you know, it's a quarterly meeting, so there's a lot to digest today. So I think it's important. All right, not hearing any other business to come before the board, I entertain a motion for adjournment. You guys want to stay? It's nice and sunny and warm out.
So moved.
We have a motion. Do we have a second? We have a motion and a second. All those in favor of adjournment, please say aye. Aye.
Aye.
Aye.
Opposed? We are adjourned. Thanks very much for all the work today, folks.
Thank you.
Bye, everyone.
Bye, everyone.